Over to you, Shah.
Thanks, Kavya. And I hope everybody that is watching this webinar is safe and sound because that's the most important thing these days. I, of course, thank Prem and team for giving me a chance to speak a little bit about behavioral biases here. And the reason why I thought that it is important is because all through the last 15 years of my journalism career, and more so the last 3 years at Bloomberg Quint when we've done this mutual fund show and some of the others, all the queries that people tend to send, somehow the problems get repeated. And it led me to think, and not rocket science out here, because I'm sure all of us kind of reason with this, that people sometimes tend to repeat the same mistakes again and again, which was probably done 3 years, 4 years back in their investing career. And that's probably because of a bias that is there in the minds. And it's very difficult to probably get over this. So as much as this session is about identifying the biases, and I mean, there are multiple biases. I have probably chosen 3 or 4, which I thought were the most common ones, and some of them are contradictory in nature as well. It's probably also important to try and overcome them. And I have one single formula for trying to overcome them, which I've learned from a number of people who have come on the shows. And I have tried to imbibe them in my investing principles as well over the years, whether in mutual funds or otherwise. And I hope that it is of some use to some of you who are watching this. Let me just try and firstly give the share screen so that I can show what I want to. All right. Just a second. Yes, perfect. So yeah, the next 10, 12 minutes, I'll just speak in a succinct fashion about behavioral biases and how to overcome them. As I said, there are a number of these biases. I'm choosing the 3 or 4, which I think are the most common ones and probably the most important ones. So the bias number 1, and this is a bit of a contradictory bias, and I'll tell you why. I think that what people believe at large is that performers, or the ones which are doing well, are doing so for a reason. Therefore, it's best to buy what is winning. And frankly, from a stock market perspective, an individual investor stock perspective, this might actually be true. The last decade is a decade of value not quite doing well, and things which are doing well, doing better. Now, I mean, a lot of people have heard about the CAN-SLIM approach and how this works very well in stocks. It probably does. But I'm borrowing something that I saw on a portal, Kuvera.in, and these are the assumptions, and the results might actually bring to you why I'm saying that this is a bias which people should do away with or control. The assumptions are that Niraj has invested in the top 10% of the best performing funds for over a year. So let's assume there were 200 funds that were chosen for this study, and the top 10%, which is the 20 funds which have performed very well over the year, Niraj has chosen to invest in them. And Niraj did not pick and choose any of these funds. He just straight away, he did not have any favoritism out here. He just chose to invest in all of these funds, the top 10%, mind you, okay, the best performing funds in a year. And look at the results. The distribution of the 5-year best performing funds 1 year later, or the 1 year best performing one a year later. And this is what's happened. I mean, actually, I'm missing a slide here. Even if you look at the 1 year best performing funds, or for that matter, the 5-year best performing funds 1 year later, what Kuvera did is they bifurcated the funds into 10 deciles, which is 10 bars of funds which are doing well. And if you look at this slide carefully, 13%, that's the number of the best performing funds which did well 1 year later. So if you chose to invest in the top 10% of the funds 1 year later, only 13% of the funds ended up as the best performing funds again, whereas 19% of the funds ended up as the worst performing funds. So as much as it might be true in the stock market parlance, data suggests, whether on a 1 year or a 5-year basis, you could actually throw a dart in the top 10 performing funds or the top 100 funds, and you could emerge that way. So maybe, just maybe, the simple way to select good performing funds is not via looking at what is performing the best, but doing the other forms of research. If you really want to know, I mean, and there are multiple ways in which you can figure out, talk to your advisor, or multiple other ways of trying to figure out which fund could do well. But certainly, what's done well need not necessarily do well. Apologies to all those fund managers whose funds have done really well, but unfortunately, data seems to suggest that it's not necessary that that fund will do well the next year. Bias number two is the compulsive anti-herd bias. Now here, all of you would have heard of these statements, or most of you would have heard of these statements, that when everybody thinks alike, there isn't much thinking taking place. Or if you don't come across any problems, you're on a wrong path. Or herd mentality hurts eventually. I think all of you would have heard of this, that if everybody's thinking in the same line, don't go out and buy that. And there is a compulsive anti-herd bias. And therefore, a lot of people say that if this is doing really well, let me not be in that train. Now, the interesting bit is, and I've borrowed this from the Jeremy Grantham newsletter in 2018, wherein he says how it's equally painful to stay out of the markets as it is to be in the markets when the markets are correcting. And this is what amplifies the anti-herd behavior. Now, look at this. Back in 1929, and this is the data borrowed, the problems were identified late 1927. Now, let's assume that you thought that everybody's still bullish on the market then, and you got out of the markets. You actually saw the levels at which you got out of the markets come back 3.5 years later. And believe me, I mean, I've heard a number of people say this, that it can be very painful to stay out of the market and the markets are going up and everybody else is making money and you are not. So you actually got out thinking that everybody's thinking that the markets are bullish and therefore I should not be invested. And history shows that your levels could actually come in way later. So even if the markets came down eventually, from your levels, it actually came back only 3.5 years later. It's actually repeated even in 2007 housing bubble as well, identified somewhere around 2003. If you actually thought that, oh, housing is under problem and fiat currency is under problem and you got out of the market, you probably missed the best bull run that we've seen in the last 2 decades, isn't it? Or in some people's minds, the best bull run that Indian markets have seen in a lifetime. So that compulsive anti-herd bias also at times comes back to hurt us. And frankly, this could be replicated in mutual funds as well, right? So don't go out and think that if everybody's thinking in the same line, you are wrong. I think fundamental research would go a long way in trying to help you not fall for this bias. The third bias is the narrative fallacy bias, right? And what I mean by this is that investors would gravitate towards investments with a good story, even if they are overvalued. And remember, again, here, this is the opposite of what CanSlim says, which is buy good stories when they are peaking and sell them higher. Because a lot of people, without doing due research, believe that if the story is looking good, let me go and invest even if the valuations are sky high, right? And lots of examples out there. People invested in BFSI funds at the peak. And frankly, I mean, at least in the short term, those funds haven't really done too well. And it hurts. People may want to believe that investors in for the long run. But in the short run, if your NAVs are really correcting badly, it does hurt you. Investing in mid-cap funds late 2017, and then the pain that people saw, or infrastructure in 2008. And I think it came to hurt people for sure. So you got to do your research, I think, when it comes to thematic funds or investing in funds which look very attractive because the story around them is all around you. You hear them on, platforms like Bloomberg, Quint, or television channels, etc., that everything is hunky-dory, and it might actually be a wrong thing to do. I think a lot of people fall for this, more so on the stock markets, individual stocks, etc. But even in thematic funds, I mean, I'm not saying that pharma is a bad thing right now, but that's the thing right now. A lot of people invest into thematic funds like pharma funds without doing due research. All I'm urging is that if people want to invest in a story which is looking very promising or sounding very promising, I think due research would be center stage. You cannot escape away from this. And if that is done, and then if you're confident that even if the markets were to go down, or even if this particular theme were to correct, the long-term vision stays and therefore you might benefit, I think it's fine. But otherwise, if you just invest into a story believing that the story is good without looking at the valuations, it might actually hurt you really, really badly. I think most people fall prey to this. And therefore, this is the most important thing to do. Every point of time, you hear about a good story and you think that let me invest into this mutual fund, or let me invest into this theme and look out for funds around this theme. Ask yourself if you understand the story clearly. And if you do not, try and first understand the story and then put the money into work. 10, 15, 20 days later, I don't think will hurt you too much if you're invested in funds for a really long term. So yeah, this to my mind is amongst the most important biases that comes to mind, most people. And this is something that I think in my commentary on Bloomberg, Quint, or even in my other platforms or other channels that I worked for earlier, now, for example, I have probably fallen prey to this as well in my commentary. I think a lot of people fall prey to this. Now, the next two slides tell you why I'm saying that this is a bias. All through the last 3 months, I admit I have also done this at times. A lot of people compared the fall in the last 3 months to 2008 bear market. And not the fall really, but the uptick that we saw post the fall. And everybody kept on saying that look at what happened in 2008 and then try and correlate it. Let me just try and take a minute to explain out here. What this chart shows, and this is borrowed from the Goldman Sachs investment research, which they use the Bloomberg terminal to do. But nevertheless, I've taken it from their note. Now, what this says is that 2008, the trough, these are the 4 dates on which in 2008 we hit trough levels. So 2008, 22nd Jan, there was an intermediate trough that was reached, and then 10 trading sessions later, we hit a bit of a peak out there in the 2008 level. So the trough to peak was 10 days. The size of the bounce was 12%. Then the market started correcting again. Again, 17th March, there was a bit of a trough. Then there was a peak, which lasted for about 30 days. Size of the bounce, 16%. Again, in 16th July and 27th October. So the markets were falling down, but they were hitting intermittent periods of troughs and then moving back again. And what happened in the current period, which is the rally that we started seeing from the 7,500, near 7,500 levels, is that everybody started saying that, hey, this has happened in 2008, but then the markets corrected, then bounced back, but again kept on falling. And everybody said that if this is going to happen, you need to be careful before you buy into the bonds, before you invest into the markets, before you start putting your money into mutual funds. Be wary of the fact that in 2008, which was the closest reliance that you saw to our market scenario currently, the markets continued falling despite the bounces. And therefore, you would have heard at 9,000, at 10,000, at 10,700, 800, everybody's saying that, hey, we are trying to correlate it to the past and therefore the markets are going to fall. So please be careful. And here's what happened. We had some troughs. But this is the big thing, right? I mean, look at this chart and then compare it to 2008. And if you actually gave a bit of a reliance to 2008, how wrong you would have been. Yes, we had the sharpest fall since the global financial crisis this year. But post that, this is dated, of course, a couple of days back. So the number might be, it would be 50% or slightly here and there. And this is for the Nifty, of course. The other markets would be different. But if we've been up 50%, in about 93 or 94 trading sessions. Now, this is my point, viewers. I mean, again, I'm not saying that this is wrong. This could well have turned out to be true, but the fact remains that it did not. And if you actually gave excessive reliance to past history and thought that what's happened in 2008 will necessarily get repeated, then you were wrong. This is not just true for the Nifty levels. This is actually even true for a lot of sectors as well. A lot of people believe that if this has happened to pharma, to BFSI in 2013 or in 2008, etc., it will happen. I think you'll probably hear some statements around this for the better performing sectors as well, that they hit a peak on price earnings multiples sometime back, and now we are at those levels. So from here, we'll necessarily correct. My point is, it may happen or it may not happen. And therefore, if you base your decision, investing into mutual funds decision, based on exactly template in the past, then you might actually review the move that you're making. I just want to bring in these biases to tell you that there is no second, or there is no alternative to doing your own research well, trying to see the things around you with a bit of a commonsensical approach, instead of trying to say that what's happened in the past will happen in the future. And which is why I think, as I end my presentation, and maybe I've done it a bit early, which is fine, but as I end my presentation, the one thing that I do want to point out is that somebody mentioned this, right? That history doesn't repeat, but it often rhymes. And I think that's a very clever disclaimer put out there, because history at times repeats as well, but more often than not, it rhymes. It doesn't quite exactly repeat. And therefore, if you believe that it's going to repeat to the T, you are going to have a tough time. viewers, keep in mind, there are a bunch of other biases that a lot of people will tell you about or talk about. I just think from my experience of talking to advisors, of talking to fund managers, of talking to CEOs, and of talking to real investors about the problems that they have had, these are the 3 or 4 that stand out for me and are the most common ones that people go through. And if via a simple method, which I'll just share as the final part of my presentation, if people can overcome these biases, it will serve them in a big way. Now, as I said, that there is no alternative to doing your own research. If you indeed want to overcome these biases, one very simple way of trying to overcome any of these biases or the other biases that you feel you have is to write it down, not necessarily just type it down in an Excel sheet, but write it down. If you maintain a book or a ledger or a memo, and you note down the issues that have happened with your investing decisions in the past, whether you got out of a thematic fund too early, or you invested into a fund, a stock for that matter, without by doing research. And if you write it down and the mistake that you've done, you note down the reasons for that. The next time that you are about to do that, and if you refer back to this, it will give you a time to pause and think about whether or not you should take an alternative approach. The answer may be different, by the way. And the answer may be that no, you should continue doing this. But keep in mind that in these markets, whether in direct stocks or mutual funds, there are opportunities every second day, every second month, every second year. What might appear as a really good opportunity not necessarily stay for that period alone. So just be mindful of that. Make a note and keep on referring to the mistakes that you've done in the past or the biases that you had in the past in order to try and overcome them and have a healthy and a happy investing career. Thank you so much.
Hey, Niraj, that was a terrific presentation from you. And I think some of these biases are very, I hadn't heard of them. And so they sounded very original to me. So are you the person behind them?
Well, actually, I did try and go through some of the work that we've done, Prem, with some of the shows and thought that these were the ones that were coming out to be the most common ones. The narrative fallacy bias is probably not spoken about, but the others, I just thought people go through them.
Yeah, and one thing, I wanted to share with you, the anti-herd bias is actually something that we've been fed on, that you don't make money when you do what the others are doing. You make money when you do what others are not doing. So how does that fit into because we've been wired to say that don't go with the herd. How do you even recognize? Because I didn't even know that this was a bias and it would perhaps work against. Yeah.
So of late, so Prem, actually it came about simply because I remember. So I'll tell you why it happened. Q4 results of Bharti Airtel, and the stock moved from 537 to 602. And on that day, I saw a tweet from one journalist saying that, oh, if everybody is on the same path, then it did not work out well, has not proven true in case of Bharti Airtel. And it got me thinking that whether or not that is right or wrong is separate. I'm not getting into that argument. But the argument that I'm getting into is that a lot of times people think that everybody's on this path and therefore it is not the right path and let me choose something else. It may not always be true. And I think then I wrote, this Jeremy Grantham newsletter I'd actually presented on Bloomberg Quint in our morning show one. And it just got me thinking that, hey, I think Grantham was trying to talk about this, that at times when markets melt up, people think that, oh, markets are actually going to fall and let me stay out of this because everybody's in this party. So many people have heard of this, right? That the party is on, but stay close to the door because you want to exit. And a lot of times people exit at the wrong time. You don't want to do that.
Okay. Niraj, much though I would have loved to have talked to you about all these things in greater detail, we have run out of time.
No problem.
So thank you, Niraj, for bringing something very original, something very refreshing to the event.
Thanks, Prem. Thanks for having me.
Wonderful to have had you here.